This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
Yeah, those are risk assets, so you're taking a lot of risk. And at the end of the day, those can, stocks can go to zero, companies can go out of business. Bitcoin is extremely volatile. It is digital property. So, that's probably the closest thing to real estate. It has a lot of advantages over real estate, but you really need to know what you're doing. You need to be prepared, to lose most of the value because it does go up and down. It's got a history of reaching peaks and drawing down 80%, reaching peaks and, drawing down. So, you need to make sure you're getting in at the right time in the cycle and you have a long-term outlook and you can weather a downturn if it happens. There's no tax advantage. There's no income. It's digital property. So, you're basically speculating that it's going to go up.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. At the time of this recording, we're winding it down 2021. Now, I'm already planning out my 2022. But with that in mind, I like to set goals around my development and acquisition deals for the next 12 months. But now, more important than ever is the ability to raise money and raise investor cash for these deals that we're working on in the next 12 months and really trying to understand what that looks like. So our next guest keeps an eye out to the future while staying very active in the real estate space. Now, he has bought and developed and sold over $250 million in real estate, built and renovated hundreds of customs houses and commercial buildings, and started 12 different companies from the ground up. Now, his current real estate clients have over $2 billion in assets under management and in deals in the process. Through his coaching business, he mentors entrepreneurs, real estate investors, and real estate developers, helping them scale their business, raise capital, and do bigger deals. Now, he also has a podcast on iTunes, the Greg Dickerson Show, that covers entrepreneurship and real estate. So definitely check that out. Now, with all that, I'd like to welcome my good friend, Greg Dickerson. So, Greg, thanks for coming on, man.
Augustino, thank you for having me.
Yes, it's going to be awesome. Now, if you like what Greg has to say, you can reach him via his contact page at dickersoninternational.com. Okay, Greg, tell the listeners a little bit more about your journey and how you got your started in all this.
Yeah, so I started with nothing in 1997. I didn't go to college. I went in the Navy right out of high school. Natural born entrepreneur. Started as a kid, knocking on doors, cutting grass, raking leaves, whatever. If I wanted something, my dad said, "Well, you go get the money. You figure out how to pay for it." So that's how I was brought up, learning how to create something out of nothing, learning how to create, whatever I wanted. I had to go solve a problem and generate the income to go buy it. So anyways, fast forward, graduate high school, go in the Navy. I did retail in the Navy. So I had a little bit of business training there. I get out of the Navy and I did two things. I did restaurants and construction. So I'd worked in restaurants and worked my way up from dishwasher to management. And then I always had a little side construction business because, I was handy and I could do things to make extra money. So I was one of those guys that, I would do whatever it took. If I wanted something, I went out and created the revenue to get it. And then in 1997, I moved to the Outer Banks of North Carolina and I was going to open some restaurants. And instead, I noticed that there was a problem that needed solving. So I bought a house and I was trying to get a little, addition put on the house and landscaping done and things like that. Nobody would call you back. Couldn't get anybody to do anything. So I'm talking to my friends and neighbors and they're all like, "Oh yeah, it's so busy. Everybody's building houses. Nobody has time for the little jobs." So I said, problem, opportunity. So I started a little remodeling handyman company in 1997. First year I did $250,000 in sales. 7 years later, it was a $30 million building company, one of the largest companies down there doing building and development, building multi-million-dollar beach houses. And I sold that. And during that 7-year period, I started 12 other companies, built them up, sold them off. And then I reinvested all the profits into other deals. and other assets. And, that 250 million you're talking about, that was me, my own money, my own banking, all of that, no investors, nothing, just me and myself and my team. So I didn't have partners. I didn't have investors. It was my cash, my money, my banking relationships. Obviously I used banks for financing, and then I had employees. So instead of finding partners, I hired people. And even though I didn't go to college, all of my top employees were all college educated. My chief financial officer had an MBA. The president of my company had, advanced degrees and things like that. So I would hire people that had that formal education, that were smarter than me, better than me at things. I brought them on board to run things, and then I learned from them. And then that's how I, kind of scaled everything I did from there. So that's the long story short.
Excellent. Now, it's interesting because to get from 0 to 250, it's using your own money. So no investors, no, well, of course, lenders. You have everybody use leverages, right?
Banks, yeah.
You use lenders and banks to do this too, right? And I'm just curious, how did you do that then? Did you just took any and all profits out of one deal, rolled it to the next one? I mean, that's what it sounds like you would have had to do, right?
Yeah, I compounded cash. So I had multiple companies. So what I did was I read Rich Dad, Poor Dad. Okay, so that was the first book I read. And then, of course, there was other books around it. But from a business standpoint that helped me understand how to do this, it came from Rich Dad, Poor Dad. When I read that book, a lot of people get real estate out of that book, right?
Yeah.
That's I didn't get real estate. What I got out of that book was I didn't want to be Robert Kiyosaki. I wanted to be Rich Dad. He had all the businesses. He had everybody coming to him. He had all this different cash flow. That's who I wanted to be. So I went on that journey, and I started all these different companies that generated cash. So I used the surplus cash, the profits, instead of pouring it back into the company. What you do to a certain degree. I use that to invest in other deals. And it started with a simple little lot flip that a friend of mine brought to me, and we flipped a lot and made like 15 grand. Now, before this, I didn't know anything about investing in real estate. I didn't even know you could flip a lot. He came to me and said, "Hey man, we can buy this lot over here for, I don't know, $100,000. My dad has a client that'll pay $150 for it. You put up the money, I'll do everything else, and we'll split the profit." And I was like, okay. I'm like, "Can you do that?" He's like, "Yeah." I said, okay. So I gave him the money. He took care of everything. We split the profit, and we made, I don't know, 15, 20 grand a piece, whatever it was. And I was like, wow, so off to the races from there. And I also started doing some projects for some investors and developers, and I started learning, how that world worked. But the bottom line was, I'm a landlord of cash. My whole philosophy was, how do you make the most amount of money in the least amount of time with the least amount of energy and effort possible? How do you compound cash over time quickly? So that's what I did. So I would take the chunks, reinvest, buy, sell, build, sell, and just grow that pile. That was my goal, not to accumulate assets, which is a great goal, and that works for a lot of people. But for me, it was, how do you accumulate cash? And then how do you compound it? Because at the end of the day, cash is king. So that was my whole goal. And that's been my business model for my entire career.
Yes, but something that we talked about this in the green room too, partnerships and working with other folks. And I'll tell you what, early in my career when I was working in corporate, I always felt that I had to do everything on my own. No partners, no friends. I'm going to build my success on my own. And it's incredibly difficult, if not impossible, to do things like this on your own. And just mentioning or thinking about your example there, it's like someone else found the deal, they brought it to you, and you put the cash up, split the profits, super. Like how many other times did you have to do this with, like, and how did you find these partners to work with to get all this stuff? I know obviously you mentioned you hired some of these folks.
These weren't necessarily, it wasn't necessarily partners. He had a transaction that he facilitated, but I did do a couple of deals with partnerships. But going back to your point, it's really not that difficult. I mean, think about it. Jeff Bezos didn't have any partners. Steve Jobs didn't have any partners. Mark Zuckerberg, doesn't have any partners. You know what I mean? So a lot of the biggest and best companies of our time weren't partnerships. It was an entrepreneur that had an idea, had a big problem that they were solving. They built a company. So to me, it was just building companies. But when it came to deals, people knew that I was a deal maker. They knew that I had cash. They knew that I had companies and things like that. And I had a good reputation with banks and people in the community. So people would just come to me, that had a deal. I had, one of the biggest deals I ever did was an oceanfront hotel. I used to buy oceanfront hotels, tear them down, and redevelop them. And it was my neighbor, that owned the hotel. and he was going to buy it and redevelop it, or he had the contract to buy it and they were going to redevelop it. And he got cold feet, and I was buying a lot to build my house on. He owned, 2 lots. And he told me about it. He said, "Hey, I've got this deal. Me and my partners are getting cold feet. If you want it, take it." And I'm like, "Okay." So, I gave him 10 grand for the contract. I stepped into his shoes, ended up buying the oceanfront hotel, flipped the lots to some other investors, and I built them the houses. And the same realtor I did that first deal with brought the client that I flipped the lots to and built the houses for. So just kind of that kind of thing. You just build that reputation as a deal maker, as a closer, as somebody that has the ability to get things done. And then people bring you deals. Another oceanfront hotel, somebody heard about that one and then brought me another deal and said, "Hey, I have this, oceanfront hotel that was, this one, the first one was $1.2 million. This one was $4 million, and then it just goes on from there, and that kind of thing." So even to this day, I get deals that come to me from just all over the place with relationships I've built over the years.
Nice. Excellent. And now fast forward to today, then, just like you just said a second ago, how's capital raising going to be different in 2022? Do you think it will be different going into the next 12 months?
Well, the thing right now is the economy's at a tipping point, nationally as well as globally. There's a lot of things out there right now, a lot of uncertainty, a lot of questions about where we're going to be here in the near term with, the Fed in the United States, central banks around the world, monetary policy, things like that. So the real question is, what does that look like going into next year? What does Q4 look like this year? That's going to, create the circumstances, and really answer that question. At the end of the day, there is no yield right now, and I don't think that's going to change. I think if anything, that's going to get even tighter going into next year. I mean, you might see rates raise a little bit, but still not enough to where there's any real yield out there. So that's pushing capital into risk assets, and there's a ton of capital out there. So if the markets sell off, that's just people taking profit. They're going to take those profits and look into other assets to put that capital to work. So I think from the standpoint of what you do and what I've done as a career in terms of real estate as an alternative asset class, which is what it is for the financial world. And when you're talking about high, net worth liquid individuals, 10, 100 million and north, they're looking, number one, preservation of capital. I don't want to lose any money. If I make money, great, but I don't want to lose any money. So you're going to see a lot more people from that standpoint, just looking for preservation of capital. And then if I can get some yield on top of that, great. So I think that's kind of what you're going to see Q4 and going into next year, especially if, we have some issues in the economy, in the United States as well as abroad.
Right. Do you think there's going to be a slowdown in the next 12 months? Do you think it's going to go push off into 23?
It looks like things are slowing down a bit. We've got inflation's a big deal. Inflation's real. It's not transitory. It's here. Wages have gone up. Fuel prices are up. Oil's up. Commodities are up. We have containers off the coast. Shipping's up. So there's a lot of pressure on the retail spender right now. And the interesting thing is all the jobs that are available that we can't fill. So that's really interesting. So I think there's some inflationary pressures out there, and I think as interest rates tick up a little bit, that'll put some pressure on the economy and things like that. So it's interesting times.
Yeah. Well, I mean, and to your previous point too, it's like when these people are putting their cash into these real assets that still produce something. I mean, just like they're expecting zero yield, but at the same time, they're protecting their money. They may see something coming back to them with the rent increases that are coming up as well. I mean, I can tell you here in Cleveland anyway, rents have moved significantly over the past 7 months, and I think they continue moving over the next year anyway.
That's everywhere. Rents are up 20-30%. In most markets that are competitive, where you have positive net migration and population growth, values obviously of all asset types and classes of real estate, housing, all the way up the food chain, with the exception of some office product and retail in some areas. Cap rates are as compressed as they've ever been. Competition as high as it's ever been for those assets. And I don't think that's going to change going into the future, but rates are cheap. So it's all kind of relative, right? When I was, doing the bulk of my deals, rates were 2-3 times what they are now. It's really interesting times out there. But at the end of the day, I think what the top economists are worried about is stagflation, where you have, low growth and you have high inflation. So it'll be interesting to see what occurs and how that really works. Because, we're a retail-driven economy right now. We're a consumption-based economy. We're not a production-based economy anymore. So it'll be interesting to see how that works.
Yes. Yeah. Well, and that's the thing though too. Really, we outsourced all of our production to China, right? And they become basically our producers. And with everything that's happening in China with Evergrande, how do you think those problems are going to affect us, and not only us, but even the global economy? Like, what are your general thoughts around that?
That's a small amount of money, compared to China's GDP. I mean, they're 30 trillion, something like that. And you're talking about right now, Evergrande's, 500 billion. But that company has other companies. So it's not like 500 billion is just disappearing. They can spin off, their other subsidiaries and pay down some of that debt. The real question is, what we don't know is, what are other companies like that? What is their position? Because the real estate market in China is in trouble. Real estate market in Dubai was in trouble. A lot of people don't know it, but Dubai was, looking at major defaults on a lot of their projects as well. So there's a global real estate crisis out there from a debt standpoint. So the real question is, these bigger companies that are exposed, how big is that, and how exposed are they, and what's the contagion there in terms of that spreading into other economies and globally. So, when the United States had our, housing crisis, 2008, 2009, that was a multi-trillion-dollar problem. It wasn't just a few hundred billion. It was trillions and trillions of dollars, and it was, credit markets all around the world. So if we get a real estate collapse globally, it's not just China, it's other countries. And if it happens in this country, if we all of a sudden see values start to reverse on us because interest rates are going up and things like that, that's when you can have a real issue from a global standpoint of a deflation of that asset level. So that's where you'll see credit markets tighten. That's where you'll see interest rates rise. And when it comes to real estate is all about debt. It's all about being able to get the money. So if rates are up and credit markets are tight, you can't get the money as easily as you can right now. That's when you'll have a problem. And that's what killed it in the residential sector, 08, 09. Commercial sector right now, it's all about the credit markets. And as soon as those tighten, like we saw back in the March, pandemic time period, lenders got really, tight with their requirements and guidelines. It killed a lot of deals. It drove asset, prices down a little bit for a few minutes there, because a lot of people just weren't buying and some people weren't selling. So it kind of, changed the market a little bit. And then it just picked up steam again once we got through that little situation, and the Fed started, buying mortgage-backed securities. And that's the thing to remember. The Fed right now is the biggest buyer of mortgage-backed securities out there. When that stops, that burden is going to be put on the credit markets. So those rates are going to go up. So things are going to change in the credit markets here, once the Fed, pulls the foot off the gas a little bit.
All right. Well, and now with all this in mind, when someone is talking to an investor and they are talking to them about putting their money into these hard assets, I mean, and of course, the investors that might be that our audience might be talking to might be a little different than the investors you're talking to. But I think that the rules are almost the same in the sense that what the economy at large is doing in relation to the world of real estate. Would you say then that putting your money into physical assets, cash flowing assets, is still the sound place to put your cash these days?
Yeah, it's the safest place. I mean, at the end of the day, what we saw when we were facing economic Armageddon in March of 2020, when everybody thought, the markets and the world were coming to an end financially, what did well? Housing. You still had to put gas in your car. Even though we were limited in travel, you still had to put gas in your car. You had to buy food. Grocery stores remained open. A lot of the restaurants pivoted. So food, clothing, shelter, medical. I was surprised at how, big of a hit the medical industry, medical, dental, those types of things. With the pandemic, they had to change, but they got through and survived. But you still need healthcare. You still need dental. That's stuff that can't be done out of your house. That has to be done in location. And then from your standpoint of what your new business model is now with net lease, the pharmacies, right? Those things, like, they went through the roof. And so did like Lowe's and Home Depot and, that type of stuff. So when you look at what did well in the pandemic, those are the core services that we need to function as a society. And even though the one sector was going down, people still need to live, eat, breathe, take care of themselves, get educated. So those are the assets you want to own and invest in that just aren't going anywhere ever.
Right. And if anything, I would say that with all this uncertainty that we discussed even in the green room, the one certain thing there is this building that I'm in right now, as a matter of fact, it's been here for over 120 years. It'll be here for probably another 100 years, I would imagine. So real estate is still going to be the safe harbor as we go through any type of economic slowdown, even in the next 12 to 18 months. I mean, that's the long and short of it. If anything, this is where your money, it's a safe bet. It's where your money ought to be.
Yeah, it is. Again, it's hyper local, so not everywhere all the time. There are certain markets that are better than others, and you want to go where the trend is and where the population's growing, and where you have good economic activity and sustainable, rents and things like that. But yeah, at the end of the day, if you're not even making any money on a piece of real estate, the income coming in is going to pay it off. So after a certain period of time, you're going to own it free and clear. And I mean, you just that's what some of the wealthiest people in the world have done. Since the history of the world, a lot of your major trophy assets that you see around the world are owned by extremely high net worth individuals or sovereign governments that, are protecting their cash and protecting their sovereignty and their estates and things like that. So, that's where the smartest, safest money in the world looks is property, because they just aren't making any more of it, in the right areas.
Yes. Now, pivoting on to other type of asset classes, many of the investors that we talk to, or some of them anyway, they'll mention things like Bitcoin or investing in stocks or that kind of thing. I mean, what was your overall position around investing in things like that, like Bitcoin or the stock market? I mean, what are your general thoughts around doing that?
Yeah, those are risk assets, so you're taking a lot of risk. And at the end of the day, those can, stocks can go to zero, companies can go out of business. Bitcoin is extremely volatile. It is digital property. So, that's probably the closest thing to real estate. It has a lot of advantages over real estate, but you really need to know what you're doing. You need to be prepared, to lose most of the value, because it does go up and down. It's got a history of reaching peaks and drawing down 80%, reaching peaks and, drawing down. So, you need to make sure you're getting in at the right time in the cycle, and you have a long-term outlook, and you can weather a downturn if it happens. There's no tax advantage. There's no income. It's digital property. So, you're basically speculating that it's going to go up. So, it depends on when you buy it. When it comes to stocks, we've seen over and over, companies can go to zero. The stock market's fickle. Bitcoin and cryptocurrencies are as well. So Bitcoin's digital property. There's other cryptocurrencies that are more like venture capital. They're like companies, and then the tokens are almost like a stock in a company that trade on exchanges. And then there's the whole DeFi space and gaming and NFTs. So there's a lot going on in the world of crypto, to be looking at. That is the future in a lot of ways, for a lot of things. From a decentralized, internet finance, investment standpoint. So it's an interesting space, but it's very risky. And there's it's not regulated at all. So there's a lot of scams out there. There's a lot of fraud going on in the industry. There's a lot of manipulation. There's a lot of things happening in those industries right now that, when you go into them and invest, you're taking on a lot of risk. And when you look at, what the, smart money's doing, and the institutional investors that are in the space, they're putting a very small amount of their portfolio in there, maybe 1% to 5%, right now. And as the space grows, as we see more regulation in the crypto space, you're going to see more capital allocated. So it's at the very infancy, beginning of the stages. So that is something to keep your eyes on and definitely learn, because there's a lot of potential upside in that space. It's where the internet was, back in the early 90s, late 80s, early 90s, right. There. Stocks are interesting. The only reason we are where we are is because what the Fed's done. So, stock market's been up since the beginning of time. And what we do know now is if it starts to crash, the Fed's going to step in and prop it back up. In terms of the current Fed, current administration, and that mindset that's there right now from a monetary theory standpoint, Janet Yellen, she's a modern monetary theorist in practice. Maybe she doesn't say it, but that's what her actions would lead you to believe. So, which is endless printing of money, is what that basically is. As long as you've got that attitude behind markets, they will stay up to a certain level, and they might let it pare down about 50% or something. But if it starts to dip, 60, 70%, the Fed's going to jump in like they did in 08, 09, pumped it up, just like they did in March 2020, pumped it back up. Now a lot of that capital is going into cryptocurrencies and Bitcoin especially. So that's where you're seeing, inflation there. And, Bitcoin went from $3,800 in March of 2020 to $64,000 in, April, May of this past year, and March, April, May of this past year, and then, went all the way back down to, 29,000 at the low, and now it's back up again to, 50-some thousand. So it's got its peaks and valleys, but so does every asset, right? And all of them have been up since the beginning of time. So
would you say
it's all about when you enter?
Yeah. Now, would you say that it's because the smart money knows that fiat currencies like the US dollar cannot just keep being printed in forever? So they're hedging their bet on crypto, or is it just people looking for just short-term gains? They say, "Oh, look, I can make." I mean, what do you think it is?
Yeah, it's not lack of faith in the dollar. I mean, we've been printing, since 2009. I mean, really for a long time, but really since 2009, hard and heavy, and we have really no negative repercussions of that yet, other than we do have a lot of inflation at the asset level, arguably hyperinflation if you look at the last 10 years. So we've reached a bubble level of inflation, in all asset types and classes, from stocks to commodities to real estate to crypto, So other than that, there has been no real penalty. We haven't seen hyperinflation, at the consumer level. We're starting to see a little bit now, but that was mostly pandemic driven. So that's the interesting thing. So the smart money is not really so much looking at, devaluation of the dollar so much as they are just, it's risk on right now. I mean, the Fed is saying you're not going to get yield anywhere else. Go into these risk assets. So they've been pushed into it. And that's what they're really looking at. At the end of the day, everybody knows, the dollar's king. If values get out of control, we'll have a little pop in the bubbles, and values will come back down. The dollar's still going to have more buying power as values come down. So.
Yeah. It's very interesting times. Very interesting times. I mean, in our case, we're still trying to find and buy and acquire assets that we know are going to be there for the long term, that throw off cash flow. I personally have a whole lot of faith in any fiat currency. So for me, yes, putting all my money into hard assets. That's what we recommend to our investors when we talk to them. It's that there's a big shift occurring. And I think with some of these new things that are coming up in 2022, in terms of new programs, new spending, it's not sustainable long term. It just isn't. We're only we're less than a year in this new administration. We've printed off $6 trillion, I think, at this point.
Yeah, we've done more in the last year than the last 8 or 9 years combined. But we've been on this path really since 2008-9 when that whole deal happened. The last time we tried to pull the plug was 2017, somewhere around there, and markets threw a fit, so they had to step back in. And then it's been unprecedented since March of 2020, and now with the spending that they're proposing at this point in the economy, when we have this huge bubble. That could be the thing that puts us over the edge, is if and when that, multi-trillion-dollar stimulus gets passed, and where those funds actually end up.
Yeah. What do you think the way out is? Is it coming up with a whole new currency? Because I know they're talking about, the Fed's talking about creating their own crypto, I heard, right? I don't know whether that's conspiracy or not, but they look to put more controls over crypto. I mean, what is your general thought around that?
Well, so they're looking at a central bank digital currency, so just a digital dollar. And, the whole idea behind Bitcoin, the whole reason that was created was a peer-to-peer cross-border transaction currency. So that was so that you could send anybody any amount of money anywhere in the world in seconds. No fees, no intermediary, no third party, intermediary to pay or anything like that. You might have a small transaction fee, from the blockchain, but that's why that was created. And what the governments around the world don't want is they don't want that. They don't want people not having to use a sovereign currency or a fee, or a government currency and going outside the system. So they're all going to create their own to kind of solve that problem, so people can just send themselves currency without having to use a bank. And really, that's at the end of the day, that's what it's all about. It's about debanking the world, and a lot of the world is unbanked, and you can't reach them. And so that's really where this whole movement started, and what Bitcoin is all about. And you can go to Bitcoin white paper and read real simple what it's all about, but that's really what it is: a cashless peer-to-peer system where you can send value around the world instantly. And, that's the advantages of what a Bitcoin is. But Bitcoin is not the efficient way to do it. It's too expensive. It's slow. It's not, it's more of the IRS calls it property. It's not a currency. And, the governments around the world aren't going to allow another form of currency to take over and become, any kind of a reserve currency. And it just isn't going to happen. The dollar will, in my foreseeable future, always remain the reserve currency of the world because it's backed by the United States. No other country has what we have, in terms of being able to have faith in the country. That's why other countries around the world hold it. But they are all creating their own form of digital currency for that reason, so that people don't go outside the system seeking these other alternatives. And, largely they're trying to protect the banks as well.
Right. I'm going to tell you, next 12, 24 months can be very interesting.
We're in some wild times right now. And, I can't wrap my brain around all the printing and monetary policy that we have and what are the real repercussions of the debt that we have. Because, a modern monetary theorist argues if you're the creator of the currency and the rest of the world wants your currency, well, then, you should be able to borrow as much as you want because you can print, as much as you want to sustain that debt. So, if you knew that I could print as much money as I wanted to, and to pay you back, 10% interest or 7% interest or whatever, you'd loan me infinite amounts of money.
Sure.
If you knew that I could sustain that payment to you in infinitum, but that's as long as the rest of the world is interested in the dollar. So if that, and our debt. So if that appetite ever goes away, if our economy ever took a real hit, that appetite would go away. People would not want our debt. And then you got a real problem, So as long as we're the reserve currency and as long as our debt is still attractive to other countries, which is all based on our economy, it's all based on our GDP and our free enterprise system of doing business, we're in good shape. But if that changes, that's when you're going to have a problem. And, it hasn't had super negative effects yet, but I think we're getting closer than ever to bubbles popping and some of those negative consequences of the artificial inflation in our economy and in currency. And it's in the markets. That's directly where you can, it's been straight up since that, $3 trillion or whatever it is that's been added in the last, year.
Yeah. Man, scary times. Well, we talked a lot of stuff today. What is your one piece of bulletproof advice you would offer to the listener that's checking us out right now?
So at the end of the day, the hardest thing for people to do is figure out what it is they want. So I'd say for anybody watching, if there's something you want to do, figure out what that is and then become an expert at it and just do it. Just get out there and do it. So if there's something you want to do, something you want to accomplish, just start, take those steps and just get out there and get after it. Don't wait because, time goes fast and it'll be over before you know it. And you and I were talking, you've achieved a whole lot real fast. It's a matter of making up your mind. What do I want to do? And then getting out there and getting after it every single day.
Yeah, that's exactly right. That's exactly right. Now, all right, guys, if you want to reach out to Greg, you can reach him via his website at dickersoninternational.com. He's got a lot of other great materials out there that you definitely want to check out. His mentoring and training program is top-notch stuff. So go ahead and check that out. Hope you got some insight on really the economy, some of the important aspects that you should consider when you are speaking to investors as to where the economy is going, and really brushing up on these sorts of things so you stay on top of that. These are the smart investor, the smart money. They're going to keep an eye on what's coming up next. So you need to be very well versed in that. Thanks for tuning in. I'll see you in the next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, head up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.